Welcome to Call Wiz, where we break down earnings calls. Today we are unpacking KLA Corporation's June quarter of fiscal 2026. The call held on July 28th.
Record print, raised wafer equipment outlook, and a September guide that steps up hard. Let's dig in.
This is KLA, ticker KLAC on NASDAQ. The deck frames record revenue, a raised WFE outlook, and an AI-driven process control intensity thesis. Reporting period is fiscal fourth quarter 2026, the June quarter. Everything we cite comes from the call transcript, the press release, or the filings.
They completed a 10-for-1 stock split effective June 11th, so all per-share numbers are split adjusted.
The print. Revenue hit a record $3.66 billion, above the midpoint of $3.575 billion and above the street revenue estimate near $3.61 billion. Up 15% year-over-year and 7% sequential. Non-GAAP diluted earnings per share was $1.05 versus a $1 street estimate, GAAP $1.04, both at the upper end of guidance.
Gross margin was 62.4% non-GAAP, also upper end. Operating margin 43.7%. Incremental operating margin hit 59%. Well above the long-term 40 to 50% model. Filings show GAAP gross margin for the quarter at 61.4% and full-year fiscal 2026. GAAP gross margin at 61.3%. So the non-GAAP beat sits on a steadily improving multi-year base from the low 60 and sub-60 prints in prior years.
Bren Higgins said the beat came from a more favorable services mix and manufacturing scale, offsetting memory pricing pressure and tariff headwinds. Services delivered $820 million, up 17% year-over-year. Free cash flow was $817 million on operating cash flow of $906 million. Full-year fiscal 2026 revenue was $13.58 billion, a bit above the $13.53 billion street mark, with free cash flow of $3.77 billion and operating cash flow of $4.14 billion.
Quality beat, not one-timers. Memory pricing remains the overhang. Looking at the filings trail, quarterly revenue climbed 3.21, 3.30, 3.42, then $3.66 billion across the fiscal year. So the June acceleration is real on a reported basis.
The guide is the inflection. September quarter revenue is $4 billion, plus or minus $200 million, roughly 9% sequential at the midpoint.
Management guided second-half calendar 2026 growth over first half at approximately 20%. Calendar first half is the March and June quarters, 3.42 plus, 3.66, or about $7.08 billion, which implies second half around $8.5 billion, $4 billion in September, and roughly $4.5 billion in December if that half-over-half math holds. That December figure is our extrapolation, not a company guide.
Foundry and logic about 73% of semiconductor process control systems, revenue to semiconductor customers, memory about 27%, DRAM roughly 90% of memory. Gross margin guide 62.5%, plus or minus 1 point. Non-GAAP earnings per share $1.16, plus or minus 10 cents on about 1.312 billion shares. OPEX around $690 million. Rising 15 to 20 million sequential over coming quarters.
Long-run model still targets 40 to 50% incremental operating margin leverage. Filings already show operating margin expanding from the high 30s in fiscal 2024 to 41.7% for full-year fiscal 2026, so the leverage story has trailing support.
Industry outlook. They raised the wafer equipment market, including advanced packaging, to approximately the low $150 billion range for calendar 2026, the fourth raise this year per the Q&A from an approximate $120 billion 2025 baseline up through prior $140 billion plus. Mid-20% growth.
Bren said calendar 2027 consensus sits around $190 billion, another mid-20s growth rate. They are sizing capacity for the more bullish scenarios.
Rick Wallace said demand signals across AI infrastructure have strengthened materially since the March Investor Day. Visibility continues to improve. They expect momentum to accelerate through the second half of calendar 2026 and significant growth in 2027.
Counterpoint. First half was supply constrained on long lead items. The raise assumes that capacity comes online cleanly. Inventory on the balance sheet has risen to $3.65 billion from $3.21 billion a year earlier, which is consistent with building to support that ramp.
Hidden growth engine, advanced packaging. They now expect approximately $1.1 billion in calendar 2026, up more than 70% year over year, above the prior high 50% expectation and almost 2 times faster than the advanced packaging market.
Rick said much of it is front-end systems pulled into packaging, hybrid bonding, and SOIC-type flows, leveraging the existing portfolio without heavy incremental R&D. Specialty process, PCB, and component inspection from the Orbotech deal are expected to grow over 25% in calendar 2026.
Bren put the advanced packaging market itself at mid to high 30s growth now versus about 20% at the start of the year. Shorter lead time business, so it can inflect fast.
One thought experiment worth flagging out loud. Shorter lead times can also mean less backlog insulation if demand hiccups, even though the company is not guiding any such slowdown.
Process control intensity is the structural thesis. High bandwidth memory, increasing EUV adoption in DRAM, and advanced packaging such as hybrid bonding are driving higher intensity. Bren said HBM intensity levels are rivaling advanced logic. More customization, base die, integration of each DRAM, and higher performance specs.
Purely as a thought experiment on why that intensity claim resonates, picture an HBM stack with multiple DRAM dies, plus a base die and integration steps. You get more process control insertion points and higher wafer value than conventional DRAM. The call itself does not quantify stack heights or layer counts, so that remains our illustration, not their number.
Rick also cited faster product cycles, higher value wafers and masks, tighter specs, design variability, and packaging. AI-driven designs are consuming a growing share of new wafer starts. Margin story, 62.4% gross margin despite roughly 100 basis points or more of memory pricing headwind. Bren expects that headwind likely continues through 2027, then normalizes from headwind to tailwind.
September guide is 62.5% plus or minus 1 point, roughly flat sequential on a big revenue step-up, but up 75 basis points from last quarter's guide on operating leverage. Long-term, they still point at the 60 to 65% band, centered near 63.5.
New products let them reset cost structure and pricing. Existing tools are harder to reprice. Muse and Arcuri pressed on pricing power. Bren's answer was deliver new capability, meet cost of ownership targets, then reassess. Thought experiment only. If the memory headwind flips to a tailwind while incremental gross margin runs inside their 60 to 65% framework, a path toward the 63 to 64% zone is consistent with the bridge they described. Not a guide, just the arithmetic of their own model.
Full-year fiscal 2026 GAAP gross margin was 61.3%, up from 60.9% in fiscal 2025 and 60.0% in fiscal 2024. Upside still depends on normalization arriving and mix staying favorable.
Capital return. June quarter, they returned $876 million, $571 million in buybacks and $305 million in dividends, against free cash flow of $817 million, returned more than free cash flow.
Balance sheet. $4.9 billion in cash equivalents and marketable securities, $5.9 billion of debt. Net debt, about $4.24 billion per the filings. Investment grade from all 3 agencies. Past 12 months, total capital returns were $3.3 billion. Free cash flow margin 28%. Full-year fiscal 2026 buybacks $2.29 billion and dividends $1.06 billion for $3.35 billion total capital returns against $3.77 billion free cash flow.
Bren said working capital and facilities investments continue to support growth. Returning above free cash flow in the quarter signals confidence cash generation scales with the ramp.
Thought experiment. Funding returns above free cash flow on a sustained basis assumes the second half acceleration lands, and free cash flow stays near the high 20% margin they just posted.
Q&A themes. On margins, Muse, Arcuri, Quattrochi, management said memory headwind through 2027, then normalizes. Path still consistent with the model. Pricing power. Hard to reprice existing orders. New products are the pricing moments.
China competition. Rick said process control is high mix, low volume, heavy on algorithms and customer engagement, with 16 to 1,700 applications engineers. When fair competition is allowed, they do quite well. They are 6 times the nearest rival.
2027 visibility. Backlog expected around $12.5 billion in the coming 10Q. Rick said he has very few concerns. The build-out continues. Lead times about 12 months company-wide. Certain products 18 to 24 months. Conversations already on second half 2027 deliveries.
Capacity sizing. They model demand 10 or 20% above consensus and build flexibility. Component lead times are the real gate. Services long-term target 13 to 15% growth, trending toward the higher end as shipments rise. 80% of service revenue is contract-based. EPC longer-term potentially high single digits with structural uplift from high-performance compute substrates. Scenarios as explicit thought experiments anchored to the street and the call. Street consensus for the fiscal year ending June 2027 sits around $17.36 billion revenue and about $5.20 earnings per share. Bear case thought experiment. If AI infrastructure slows and memory pain persists longer than Bren outlined, you could sketch something closer to $15 billion revenue and around $4.80 earnings per share. Call it roughly 20% probability in this exercise. That sketch is weakened if September hits $4 billion plus and the half-over-half 20% math stays intact.
Base case thought experiment, about 55% in this framework. Guidance tracks in the mid-20s, WFE growth construct holds, producing something near the street's $17 billion revenue zone and about $5.20 earnings per share. Invalidated if hyperscaler capex weakens late 2026. Bull case thought experiment about 25%. $17 billion plus revenue and $5.50 plus earnings per share if packaging, HBM intensity, and supply all compound. Invalidated if advanced packaging fails the $1.1 billion calendar target or intensity does not show up in the mix.
Fiscal 2026 diluted earnings per share was $3.66, up from $3.04 prior year on the split-adjusted filings basis. So the base and bull sketches imply continued strong earnings growth off that print. Annual free cash flow has held near $3.7 to $3.8 billion the last 2 fiscal years while buybacks stayed above $2 billion, which is the capital return backbone behind any of these paths.
Counterweight, first half supply constraints were real, memory drag continues into 2027 by their words, and China remains a share pool they cannot fully access. Evidence right now. Backlog trajectory toward $12.5 billion, 4 WFE raises, the September $4 billion guide, and the filing's steady quarterly revenue climb leans away from bear, but risk is real.
Bren's construct, broadening leading-edge logic, HBM, greenfield fabs, packaging, and better supply, is the base case skeleton.
Bottom line, clean beat and raise on both revenue and earnings per share versus street and versus guidance midpoints. Process control intensity is rising faster than underlying WFE on their telling. Memory pricing is a near-term drag with a credible normalization path into 2027. Advanced packaging at $1.1 billion and 70% growth is the underappreciated swing factor. Services and Orbotech-derived businesses add ballast, and the filings show free cash flow and capital returns already running at scale.
Watch list for September. 1. Does second half track to approximately 20% growth over first half? 2. Memory pricing headwind magnitude versus this quarter's roughly 100+ basis points. 3. Is the $1.1 billion calendar 2026 advanced packaging target on cadence?
Rick and Bren emphasize they are adding capacity, customer engagement is intense, and they remain focused on the 2030 target model without resetting it yet. Bren closed on supporting customers, investing in innovation, scaling capabilities, and executing the capital allocation strategy.
Reminder for everyone listening. Everything we walked through today, the scenarios, the extrapolations on margins, the half-over-half math, were thought experiments for discussion, anchored to the call and the filings. None of it is financial advice.
Thanks for listening to Call Wiz. We will be back next quarter to see whether the 20% second half acceleration and the packaging ramp land the way management just framed them.